institutes. And our following panelists to come onto the stage. They are Mr. Ben McQuhae, Vice President, Hong Kong Green Finance Association, founder, Ben McQuhae & Co. Ms. Anna Ng, Regional Head of Operations for East Asia and Pacific, IFC, and Ms. Ellie Tang, Director, Sustainable Investing at Fidelity International. Let's have a group photo first. Thank you. Please take your seat.
Okay, good afternoon, everyone. Welcome to this ESG panel discussion. My name is Guojun He, and I'm honored to be the moderator of this session. Okay, before we dive into the discussions, I just want to thank all the panelists and everyone to participating in today's event. Okay, so today we are here not just to discuss the challenges, but also explore new opportunities, as well as share insights about some of the new development of ESG. As you are probably aware, ESG have got great momentum in the past few years. So not just as in kind of ethical pursuit, but also for long-term value creation and also sustainable growth. So today we're honored to have the opportunities to invite 3 experts from different industries to share with us about their opinions and insightful ideas. Okay. So I also want to probably say that this is probably among the few areas that the major economic powers still share common interest, want to work together, and it's not only become important in finance, investment, but also broadly in many, many industries. Right, so Hong Kong as a kind of global financial center, I think it has this unique position to help to promote sustainable growth, help to promote and integrate the ESG into business. So today we have, has been just introduced 3 experts, Ben, Anna, and Ellie, to share with us. I prepared a set of questions. I'm going to start from the gentleman next to me, because as you can see that among our 3 experts, I usually start from minority, right? So Ben would be the minority in this session. Okay, so Ben, the first question I have is kind of a general question. How is Hong Kong positioned to lead the development of green finance as well as in ESG initiatives in both the region and its network across the region?
Great. Well, thank you, Professor He, and for inviting me to speak today, and actually for your generous introduction, because you could have also said that you were starting with the oldest, which I'm sure would also be true. So let's just try and unpack that a little bit, because ESG, sustainable finance, is very much a sort of a competitive sort of concept nowadays. Every sort of self-respecting financial center globally is now trying to establish itself and its credentials as a leading green or sustainable financial center. And of course, Hong Kong is no different. And so, but in order to establish ourselves as a leading green IFC, then of course, you know, we need to work very, very hard in order to sort of earn those credentials. And I think probably the first point to note is that, you know, we have no divine right to be a leading sustainable financial center. Okay, we're going to have to work very hard in this competitive landscape that I mentioned, and we have to look carefully at our advantages and the sort of features of our financial center that would give us competitive edge. Now, clearly we have a sort of a unique quality in that we are an international financial center in China, and that provides sort of unique opportunities. We hear a lot about Hong Kong as its sort of super connector capabilities. We speak a lot about sort of Hong Kong as a financial center to support Belt and Road initiatives, and I'm sure the list goes on. We also have other opportunities that we can leverage to establish our leadership status, including things like the fact that we have a well-established financial infrastructure. We have clear regulations. We have the legal system that we have. We have high levels of education, skills, etc., and so the list goes on. And so I think it's clear that we could be a leading international green or sustainable financial center, depending on how you want to phrase it, but whether we achieve that objective is still very much sort of to be determined. And I think, a point that we always have to be mindful about is, what does it mean to us to be a leader in this area? Okay, now, leadership in sustainable finance and ESG could be measured by sort of financial measurements, and indeed these have to be very important, particularly on the finance side. But I think we should also measure leadership by reference to the standards that we set for ourselves, the standards of disclosure, the standards of transparency, standards of integrity and quality of our products. Okay, and so this is something that we're getting better at, but I don't think any of us sort of hand on heart can say that, we are sort of leading and setting the benchmark for best practices internationally in these areas yet. Just very quickly on sort of Hong Kong's sort of, I guess, role, I don't think I'll be surprised if Hong Kong or other international financial centers really consider their role to be to sort of positively influence ESG sort of standards in other jurisdictions, but influential financial centers do have influence or indirect influence. So, for example, over the years, we can point to numerous cases where our financial and financial services regulations in Hong Kong kind of follow a trend that's been set in other key markets, whether it's the EU or the UK or wherever it may be. And I think the same is true for ESG standards. If we can aspire to the highest standards, then I think we can pull others along with us.
Yes, so to follow on that, can you tell us a bit what collaborative efforts that were underway or planned from Hong Kong side to work with the other Asian economies? Can you share with us a bit?
Sure. I mean, I'll share a little bit because I'm sure there's so much collaboration. I'm not sure I know everything. I'm sure I don't know everything that's going on. But perhaps the first point to make is that we're trying to sort of move the entire global financial system. We're trying to transition the financial system to something that's more future-proof, that's something that's more sustainable. And we can't possibly achieve any of our milestones and sort of big picture objectives unless there is collaboration, and a collaboration at every level amongst all stakeholders. So just to give perhaps a flavor, I guess at a government level, I know that there are sort of ESG and sustainability initiatives within the APEC organization, within ASEAN as well. I'm sure that most of the members and our sort of regional neighbors also have commitments to decarbonize under the Paris Agreement, as we all do. I think perhaps the next level down, regulators play a very important role, particularly within the context of international financial centers, because in the areas of ESG and sustainability, what we want is a sort of a consistency across markets. And so IOSCO, which is the Association of Securities Regulators, I think deserves special mention. They've been involved in a lot of initiatives and put out lots of recommendations on things from carbon markets to ESG ratings to fund labeling, etc. And so the list goes on. It's important, they're not a regulator as such, but global, I suppose, standard setters like IFRS, who, most people here will know of or somehow be familiar with ISSB, the new sustainability reporting standards. It's inconceivable that ISSB can be rolled out and adopted on a global scale in a relatively short timeline, other than through organizations like IFRS. And of course, Hong Kong is part of the movement of early adopters of ISSB. And then there's all sorts of initiatives at a lower level, industry level. So I'll stop there, shall I?
Okay, thank you very much. So I have another question that is prepared for Anna. We know IFC has a lot of ESG initiatives. And those initiatives have covered a wide range of projects, sectors, and buildings, right? And I just want to understand, when you try to implement those strategies and initiatives, many of them were in developing nations, right? So in those nations, we know that the good quality data are often very difficult to come by. And how do you try to do, for example, due diligence, and how do you make sure that your initiatives are going to be delivered and measurable?
Yeah. Thank you. So first of all, thank you for inviting me to this conference, and really happy to speak about this topic, which is very close to my heart. So International Finance Corporation is part of the World Bank, and our mission is really to look at private sector development in emerging markets, so developing countries. We don't invest in developed countries. Our investments and work focus primarily on developing markets. ESG really has long been part of our DNA from day one. Even before all this talk about climate change, sustainability, this has been embedded in our philosophy, our mission, and our projects from long ago. So in 2003, we actually helped to establish the Equator Principles. And that is actually based on a set of IFC's own performance standards for both E&S and also corporate governance. And this has been implemented across more than 100 institutions over more than 38, probably in 38 countries per se. For us, besides this set of framework that we work on, we have a very dedicated E&S team that is involved in every single project that we do. And we get very involved, this team gets very involved in the project from very early stage on conception, all the way until we have done our investment and when the money actually is paid back fully. So it's actually quite a robust process of monitoring. I would say that they primarily look at 8 key areas when we look at the project at the onset. So this could be the labor and working conditions. So let's say it's a manufacturing, it's a textile industry. We look at the factory, we look at the workers' labor conditions, we look at the policies that they have, the incentives that they have. We look at gender, we look at energy efficiency. And we also look at if, let's say, we are looking at a buildings project with a developer and there is resettlement, for example. We look at resettlement of the indigenous population. How are they affected? Whether they are duly compensated. We look at also pollution and whether this piece of land is for conservation reasons, for heritage purposes. So all this, we identify at conceptualization what are some of the key E&S concerns that we have in the project. And then we go into the due diligence process where our E&S team will have a whole list of questionnaire. We actually go through, sector by sector, or actually section by section, the key issues that we identify. And from there, we then build an action plan together with the company, right? This action plan, we have to have accountability, which is very important. So it's actually embedded into the loan agreement that we have with them. And it sets out, ambitions, targets, action plans to address certain issues that we think might not be in line with our own performance standards. Now, once the money is committed and is dispersed, it goes to a portfolio manager to manage the project. And during that performance management stage, the portfolio manager actually works also with what we call a performance evaluation team that then, closely looks at the action plan, looks at whether they have achieved the action plan before we disperse the money in tranches. So I think there's this definitely accountability that we look at, that we want to work with the company. There's a group of professionals that can actually advise them in the process on how to do this, that, and whether the action has been taken. But I think more importantly for us, it sets an open book for everybody to see what we are doing and hold the accountability there. and it's a good showcase of what this company can do, and therefore what can be replicated by the other players. So I think last point I will make is, for IFC, very often when we talk to clients, they are really not looking at us purely for financing. It is the non-financial additionality that is very important, and one of the non-financial additionalities is really this E&S governance process that we put in place for them. When they get our endorsement on their ESG, it is some kind of international recognition that they have done well, and it is some level of stamp of approval. And actually that helps a lot in them raising financing from the other private sector players as well.
Yeah, thank you. So as both mentioned, it seems like the financial sector is a major driver of this ESG trends adoption and integration. So I want to invite Ellie, who is now the Director of Sustainable Investment of Fidelity International, to share with us a little bit from kind of financial or finance industry. How do you view about this development of ESG funds? How do they perform relative to others? And in particular, do they actually deliver to both the investors and also the impacts? Thank you.
Well, first of all, thank you so much for having me. I'm delighted to be here to join this discussion and learn from the experts on the panel. And thanks, Professor, for posing the million-dollar question to kick off this very exciting discussion. I think this question actually comes up in a lot of client discussions from an asset manager's perspective, right? So against a general backdrop of market downturn, it's true that ESG equity funds, as compared to how they performed in 2020 and 2021, in 2022, 2023, they have slowed down a bit. But if we look at the first 3 quarters of 2023, ESG equity fund inflows actually came to about $20 billion US, and they have outperformed the non-ESG equity counterparts. So it is showing a bit more resilience, even in pretty poor market conditions. And regionally speaking, this morning in the first panel, we heard a lot about the anti-ESG sentiment in the U.S., driven by politics, inflation, etc. So regionally speaking, U.S. ESG funds weren't performing as well as those in other regions. But if we zoom in to look at the emerging markets, especially over here in APAC, we're seeing a bit more investor interest. So this could be attributed to a couple of things. One, the rise of ESG regulation. So Ben has very kindly teed up this discussion about how Hong Kong, as a regional sustainable finance hub, has very much referenced the trajectory of regulatory push in ESG from the European Union, right? And of course, we have adapted a lot of these regulations to make them fit for purpose and fit for our geographical context. So we believe that these are some of the main reasons that have driven ESG fund performance in emerging markets, especially in Asia Pacific. But I think it's worth to highlight that when we talk about ESG investing, sustainable investing, it's no longer pinning sort of non-ESG funds against ESG funds. The sort of boundary between the two camps has actually been blurred. Because of regulatory requirements for companies to disclose more. And gradually, there are more regulatory mandates facing financial institutions, be it your insurance company, financial bank, or an asset manager, to disclose your product strategy, what you mean when you are launching a sustainable or ESG fund. And there are increasingly stricter requirements to sort of guide how we package our products, so to speak, and how we, as portfolio managers, investment professionals, allocate our capital. So in short, when we talk about sustainable investing, we're referring to a full spectrum rather than sort of like one siloed bin of do-gooders investment projects, right? So traditionally, there's socially responsible investment, or taking an exclusionary approach to screen out the negative sectors, the business activities that cannot transition to a more sustainable future. to an ESG tilt, which has a bit more consideration of ES and G factors in the context of fundamental financial analysis, and all the way to sort of driving impact first, impact investment. And a lot of these, ESG fund regulations that we briefly touched on already have an idea of what each style of sustainable investing products should look like. So as an investor, whether you're institutional or retail and what have you, we can have it all. I think, in terms of financial performance, it's not really fair to sort of compare ESG against non-ESG because, as Anna has mentioned as well, even in the private market, investors are looking for more than just the financial return. So putting money in sort of ESG investment opportunities, investors are sort of guaranteed a more well-rounded risk management approach to deliver quality risk-adjusted returns. And if one is interested in sort of investing directly in impactful projects, there are also a lot of those products coming online or already live in different asset classes, including in Asia. Say in Hong Kong, I think we've done a very good job as a key financial market in the world, and of course in APAC, to sort of reference the Sustainable Finance Disclosure Regulation in the EU and other key pieces of legislation to develop our ESG fund criteria. Meaning if we want to register or launch an ESG or sustainable fund in Hong Kong, the product will have to meet all of those disclosure requirements and sort of product design requirements as laid out by the SFC.
Yes, great. But when we think about the question, now the funds are trying to invest in better quality, ESG performance good, this type of firms. But how do we know this type of investment strategy actually impacted those firms? Do you actually look at not just the returns of those investments, but the actual influences on the firms that you want to you are investing in?
So most asset managers or institutional investors around the world tend to have a team that looks after stewardship and governance. So before the emergence of ESG, of course, as investors, you would contact your investee companies and understand how their team is made up, their upcoming business strategy. And with ESG, becoming more of a focus, there is increasingly mature annual disclosure in terms of laying out the ESG factors, the performance. But of course, this poses a challenge as well because to date we don't have sort of one set of standard to evaluate ESG or to disclose ESG. But it's quickly harmonizing with ISSB, coming online, etc. But essentially, we have two I guess key tools. As an asset manager to hold our investee companies accountable. One, using engagement to understand how this company is positioned to drive ESG, if they have in-house know-how to at least meet the regulatory requirement in their jurisdiction, or even better, meet international best practices to sort of compete against their sector leaders. And also to supplement where a company's disclosure is lacking. And this is quite relevant to APAC as well, because some of the markets in this region do not yet have an annual ESG reporting mandate, meaning the disclosures on ESG by these companies is quite fragmented. So if we don't approach a company to dig deeper, we are probably missing some key metrics and key qualitative information to sort of educate our fundamental analysis. And the second tool in our sort of mixed tool bag is proxy voting. As a shareholder, we can use our votes to hold our investees accountable for their current actions, their performance, and their upcoming trajectory. So key global ESG issues such as climate, right, achieving net zero carbon by 2050, and then increasingly biodiversity. As a key asset manager in the world, Fidelity International has already laid out our proxy voting guidelines, which means our investee companies by a certain deadline would have to meet our minimum requirements for disclosure, policy, and target setting. If not, then we'll have the right to vote against those proposals put out by the companies.
Okay, thank you for the very insightful and informative sharings. Following on, I think several panelists mentioned about this, about the inconsistencies of ESG ratings and challenges in measuring their impacts. I just want to, as scholars, we also use ESG data to do all kinds of research, and there are maybe, at least my understanding is more than 10 large organizations that have been trying to give ratings to different companies, and many of them are inconsistent, right? Sometimes even kind of conflicting with each other. I want to know from kind of the industry and also like the Green Finance Association's perspective, how do you think it will go, right? So how do we harmonize, or how do we kind of make those results more consistent across different rating agencies? Ben, you want to share something?
Okay, thank you. I mean, there's quite a lot of sort of implication and assumption in your in your remarks, and I suppose in your question, which is great. So we need to think about whether we have an inconsistency issue. We need to think about whether some level of harmonization within ESG ratings is going to be helpful, and then we have to consider, well, whether regulation or some sort of management, as it were, of the ESG rating industry is going to allow us to achieve those objectives. Taking a little bit of a back step, I think for a lot of people, you know, perhaps their sort of first introduction to ESG ratings and at least the perception of inconsistency was, I don't know, it was a year or so ago when ExxonMobil scored more highly and received a higher ESG score than Tesla. The thinking being that, well, you've got an oil and gas company that's doing better than an EV company. How can that be? And depending on sort of which side of the fence you're sort of shuffling around on, it's either confirmation that ESG, you know, is a scam and it doesn't work, or it's confirmation that, you know, the system's rigged. But actually, it's more likely to be a reflection of the fact that the market currently, and don't forget, it's a very early stage of evolution of the ESG ratings market. At the moment, it's more of a reflection of the fact that we don't really know what ESG ratings are for, and we don't really know how to sort of interpret ESG ratings. And so part of that is the fault of the providers, of course. They can do a better job in informing and explaining, and part of it is the fault of the market at large for not being perhaps as up to speed as we ought to be. Now, it's important to remember that ESG, and Ellie touched on this, ESG is a very, very broad spectrum that covers many, many issues and criteria which often aren't connected, okay? And so ESG rating needs to try and figure out how to span that entire spectrum. It's completely different in that regard to credit rating, okay? And so to give an example, so if an ESG rating is given where the methodology has been designed to score a company based on performance as an employer, as employee satisfaction, something along those lines, more of the sort of social elements of ESG, then it should come as no, I mean, we shouldn't have any sort of instinctive assumption or bias about which type of company is likely to do better than others. Maybe Exxon is a better employer than Tesla. But if the methodology has been designed to provide a score based on sort of emissions or environmental performance, then of course we'd expect the oil company to score very, very badly and an EV company to score comparatively much more favorably. Now, all of that can be relevant, okay? So I think that we need to do a better job in sort of understanding and using ESG ratings. Now, personally, I support the management of the ratings industry, and I choose that word carefully because in some jurisdictions it's going to be regulation, in others it's going to be codes of conduct, voluntary or otherwise. Some form of management I think is useful, in part because I think we have the benefit of lessons learned from the evolution of the credit rating industry, and in part because we really need to prioritize the acceleration of ESG ratings and the use and usefulness of ESG ratings in the market. To me, transparency is key, and I think when the when the rules require greater transparency, when the market has a much better understanding of how ratings and methodologies work and how they can be applied and should be applied, then I think that's going to do a lot to eliminate confusion. And when we reduce, if not eliminate confusion, I think that will reduce, if not eliminate, the need for a sort of forced harmonization. And perhaps just very quickly, because everyone wants to know what's going on in this space. So a number of financial centers, jurisdictions, have been looking at regulating the extent to which and how they should regulate ESG ratings. At the end of last year, IOSCO came up with their, I guess, 10-point recommendation for its voluntary code of conduct to I suppose, self-manage and self-administer a voluntary code of conduct within the industry. I think it was in December, maybe it was in November, we saw an announcement in Hong Kong that SFC had asked ICMA to convene a working group comprising primarily of ESG rating providers and data providers to work on a sort of first draft code of conduct for Hong Kong for public consultation. It's a little bit of a tricky one because voluntary codes are fine provided they work. And in the area of ESG ratings, there aren't that many jurisdictions, and Hong Kong's definitely one of them, where ESG rating doesn't really fall under any regulator's sort of authority. And so we just need to be careful that if we have a voluntary code, that it's effective, and it's not a voluntary code just simply because ESG ratings is not an activity that's currently regulated by SFC or any of our other regulators.
Great. So it seems that there are things that we can look forward to see in the coming years about how we harmonize those ratings. Related to this kind of discussion, we know that IFC has been developing industry organizer standards, right? So which shares some commonalities to ESG ratings and what dimensions should be considered and so on and so forth. Then from IFC's perspective, what are the kind of major challenges or barriers when you want to promote those industry standards and how, in practice, do you have some examples to share with us and how we can make it more effective?
Yeah, sure. So I think one of the challenges that we see is really lack of quality data. That's one. And the other one is really a systematic way of measuring impact. I think that's been also covered in this panel discussion. So at IFC, we have kind of identified or prioritized 5 key sectors where we want to focus our ESG work on. And these 5 sectors together contribute to maybe about 90% of GHG emissions globally. So they are energy, cities, transport, manufacturing, and then lastly is this nexus between agriculture, water, land. So within these 5 key areas or sectors, we have actually put in place different systems or policies or frameworks and measurement matrix. Let me just give maybe broadly 2 examples. So in the financial sector, for example, where we're working very closely with banks that is helping their clients across different sectors. We have worked with, or we have supported this network called the Sustainable Banking and Finance Network. That's got about 80 members today, and it has both the public sector and the private sector. So industry associations, Ministry of Finance, central banks, Ministry of Environments across different countries. And they have put together what we call a measurement framework that has got 3 key components. So one is really a progressive matrix. So the matrix actually tracks, the different progress of the company throughout the whole process of the project, from project preparation to implementation to maturity. And the second one is pillar benchmarking, which is quite important. So as we expand it, because of our reach in the emerging markets, we collect data from different countries, and of course it's anonymized, but you have some kind of benchmarking that the companies can actually benchmark their performance against it. So within this pillar benchmarking, again, there's 3 subcomponents, including how ESG integration right? How is ESG being integrated in the process? Climate natural risk management, and then financing the sustainability of it. And lastly is this network has managed to start collecting sector and data and case studies. So besides the country data, there's the sector data, and then there's the case studies as examples to show how we can do it. So that's one example. I will take another example that is more specific to the building sector. So in the building sector, IFC has created this tool called H. I have to get this right. So H stands for Excellence in Design for Greater Efficiencies. So this is actually an app. It's very user-friendly. Any developers, whether you are doing a warehouse, you're doing a factory, you are building a hotel, or even residential buildings, low-cost housing, which is one aspect that we do a lot of investments in, you can actually go into this tool and key in certain data points that will tell you how energy efficient you are today. And the objective of that is we will then work with the client to say, today you are here, and we want to achieve at least 20% of better performance. And we measure it with this tool. And if you get that 20% of, let's say, lower GHG emissions or better energy efficiency through, let's say, saving or conservation of water in the building, conservation of electricity in the building, or even in terms of building materials, for example, what kind of materials that you use and how does it result in greater cost savings, then you get what we call H certification. And this certification is quite internationally recognized. That's equivalent to the LEEDs, for example. So this tool we find has been really useful for emerging markets because it's actually tailored and built for mass market use. It's very quantifiable because it has got all the metrics. And again, back to the same point, because of our reach to all the emerging markets, over the years and over the decade, the system has started to collect data from all the different countries on the building sector. So that provides very good benchmarking of where you are. And it also has another layer, which is it also looks at the country's own buildings policies and regulation. So there's a lot of integration that has been done to actually nail down to measuring the impact of the sector. Just one last very interesting point. As we launched this, we also started to collect data on the companies that are doing a lot on ESG and doing a lot on energy savings. Is it making economic sense for them? Because one of the challenges that we keep having when we talk to clients about investing in ESG is, I want to do good, but does it affect my profitability? I can't have accountability to my board, and I have to convince them. And based on the data we have, we actually saw that the certified green buildings can yield up to 8% higher in tenant income. And the sales premium for commercial buildings that are green is actually about 31% higher. So based on such data point, it actually becomes easier to convince them that it's actually very important and is good for you from a profitability standpoint to actually make your buildings greener.
Great. So thanks for sharing about the experience, especially in the building sector. Also, I want to follow up, and maybe the question is also for Ellie, right? So I think all the panelists have mentioned about the quality of data. And also for all those investors, financial institutions, they seem to also have their own ways of collecting data and the use of the data. And many of those data efforts, collection efforts, are, I think, repetitive efforts, right? So a company might face 10 different organizations asking about similar information, and they have to fill in these long forms. And over time, they get tired of that, right? So I just want to kind of seek your opinion about how do we reduce this kind of this waste in efforts, right? Is it possible that different financial organizations, different rating agencies, they actually share the baseline data and make it public, including those data you just mentioned IFC collected, right? So for academics, we also want to have reliable data. We never really understand where this reliability comes from. So I just want to hear about your opinions. How do we make sure data transparency and data consistency and data collection efforts are going to be better kind of used and better utilized?
There's definitely no perfect solution at this point, but I think the positive news is that as we are seeing the harmonization of reporting standards, right? It's no longer about requiring companies to put out qualitative narrative or like just a policy of how they're managing various ESG issues. The requirements are down to metrics. And say for climate data that most of us are very concerned about, there are more of a best standard, right? Most people in large companies putting out annual disclosure on ESG would rely on the greenhouse gas emissions protocol to sort of scope their emissions, so to speak. Unfortunately, we will need some sort of top-down effort to come up with a harmonized, there has to be more than just one way of evaluating ESG. And I guess fundamentally, it's understandable why there are different ESG rating methodologies. Unlike financial accounting, ESG issues by default are not all quantitative. Right? So coupled with the lack of data we're seeing in emerging economies, even in the developed markets, right? How one sector evaluates good social outcomes could be quite different from another sector. So from a corporate perspective, we as investors would encourage better two-way communication. As a lot of asset managers, Fidelity International included, have our own proprietary tools to measure ESG. But given that it's proprietary, it's not out in the open. So without communicating with our investee companies, we don't know what they don't know. So the best bet, I think, is to sort of understand your priority stakeholders, like what they care about, and of course your sector materiality, right? Identify, say, the top issues that are of ESG significance, but would also affect your financial bottom line. I think that's kind of the 5-second answer to that question.
Ben, you want to share something, or Anna?
Yeah, I would just add that as an investor, we try not to replace what they have. We try to adapt from what they have, and we add on, right? Especially with our conversations with banks, very often these are global banks that already have very good standards, and it's comparable to what we have. So we just look at what they have, we look at what we have, we do a comparison, and we just add on or fine-tune. And then that becomes, and very often actually it's pretty similar on maybe 80% of the time, right? Maybe just 20% of fine-tuning. So we try not to be to repeat whatever efforts they have. And the worst thing to do is to force the client to take your standards and they have to create or hire new resources for that, or create new systems to track that.
Yeah, perhaps just a brief comment, just to throw the cat amongst the pigeons a little bit, because, as your question alluded to, the collection of data for a lot of companies is a real pain. It's time-consuming, it's tedious, it's expensive, and of course there are lots of tools, including those that we've heard about today from Anna and Ellie, that are being developed, and many others just to ease that process. Now, as we just begin to get our arms around, or feel like we're getting our arms and minds around ESG and ESG data, then I think the current, I don't know if trend would probably be to understate what it is, but within sort of the financial community, then, and I'm just going to quote what a sort of senior banker said to me in a roundtable just a couple of months ago, which is ESG investing is dead. Okay, it's all about impact. And so, whilst all of our regulation around sort of data collection and perhaps less data collection, but regulation around data disclosure and by extension collection are all primarily focused on risk, we now need to figure out, well, how do we sort of design and how do we measure impact? And that's actually a different proposition. We're not starting from ground zero because there's impact investing has been going on for a long time, but we do need to start sort of recalibrating our thoughts on as investors around impact as a sort of measure of sustainability. As impact as a measurement as opposed to ESG.
Okay, thank you. I kind of recently there's a trend or a kind of new proposal about emphasizing biodiversity. So as kind of an outsider, I actually do not really know what does that mean for financial institutions and for corporates when they design biodiversity strategies. So I noticed that Fidelity International actually have discussed this initiative in its report. Ellie, can you say a bit more about letting the audience understand what's going on here? What does it actually mean?
Yeah, absolutely. I'll try to keep it within the time limit. Biodiversity generally refers to the richness of our ecosystem. And this is very much relevant to not only the investment case, the economy, right? It's about our survival. A lot of the ecosystem services that we take for granted, the clean air we breathe, clean water we use, moderate climate that we get to enjoy, are all part of these ecosystem services that are often not internalized in the capital markets related calculation. So I just want to share a couple of pretty daunting pieces of statistics here. So in the past 50 years, global wildlife populations have declined by 70%, 70 on average. And with about 50% of our annual GDP being moderately or highly dependent on natural ecosystem services, I think this is a problem that's too big for us to completely ignore. And if we can agree on our goal to meet net zero by 2050, we must have a rich ecosystem and rich biodiversity. Because how we're going to achieve the net and net zero would very much be dependent on nature-based solutions. For example, carbon abatement or wetland credits, what have you. There are very a lot of tools out there. So why should we care as an investor, right? Yes, like we acknowledge there is a risk. Because ecosystem services are so fundamental, and a lot of our business sectors, industries rely on raw materials to survive. This is, something that's relevant to our, long-term prosperity and our survival. And according to the World Economic Forum, nature-related financing gap currently is about $8 trillion US. So there's a long way to go to invest in related opportunities. So what does that really mean, right? What sectors are we looking at? It's a really complex issue, but as an investor, we must try to sort of boil down to something that we can grasp on. So there are generally 5 key direct drivers of nature loss, and they include climate change, sea and land use change, direct exploitation, invasive species, as well as pollution. Now, a lot of these key drivers are systemic risk in and of themselves, but they're also very much interconnected. The worst climate change impact that we see, there will be faster direct exploitation, more habitat destruction, and to us as individual human beings, that could mean a drop in agricultural yield. It could mean threats to our food supply chain, our goods supply chain, et cetera, et cetera. You can imagine what the dire conditions would look like. So what is the global community doing about biodiversity? I think we can sort of summarize the actions that are happening as we speak in a few key points. One that has to do with setting the right policies and international commitments that's focused on biodiversity. So in 2022, there was COP15 focusing on biodiversity discussions, which has published a global biodiversity framework with pools of funding set up, targets for different countries and different sectors to sign up for. In terms of company-level disclosure, we're seeing a leap in nature-related metrics disclosure as well. I'm sure a lot of us in the audience have heard of TCFD, the Task Force on Climate-Related Financial Disclosures, which created a framework to put us together and think about how we report on climate-related risk and opportunities. So similarly for nature, there's TNFD, which was already launched, and the IFRS reporting standard, ISSB, so to speak, has already announced that they will incorporate TNFD metrics. So that means for major markets that have adopted ISSB for their upcoming issue reporting, they will have to report on their nature-related metrics as well. On an investor level, because this is, such a complex issue, and you can imagine, for a company, we can't just look at its direct operation. We have to understand upstream and downstream nature-related risk as well. So there are a lot of collaborative investor engagements. One of the major ones is Nature Action 100. So it's sort of an investor club that has come together, identified 100 companies around the world across sectors that are facing sort of priority nature-related risk. And investors with common interests, common holding, can join these collaborative engagements and talk to these companies and make sure they are setting relevant policies, targets, and disclosure to make sure they're focusing on addressing biodiversity risks. And at Fidelity, in 2022, we published our deforestation framework as a first step, because we talked about the key direct drivers of nature loss, right? So if we sort of try to map those key drivers to relevant sectors, we have the best data. It's not perfect, but it's best effort, more comprehensive data around deforestation in key sectors such as forestry products and like built environment related companies. So we started off mapping out our commitments as well as our investment frameworks. We have established our proxy voting guidelines for deforestation. So case in point, starting 2024 this year, our investee companies must meet our minimum voting guidelines for deforestation, meaning they need to have a relevant policy and make relevant disclosures. And this is not something that's sort of a one-way preference from investors, because if we look at ESG regulatory development, right? In EU, starting early this year, there are due diligence requirements for EU companies to disclose their overseas suppliers, climate risk, nature risk, what have you. So this is something that APAC companies, even if they're not listed and subject to ESG overall reporting requirements, should take note of.
Okay, thank you. So actually, we're running out of time. But I heard a lot of new words, new terms, when our panelists try to share about the ideas. Maybe last question. I think, yes, of course, many of the audience actually know about ESG and the trends and so on, but I guess some of us do not quite know what's going on. Do you have some recommendations about, for example, what programs that HKU Business School should have in order to educate the people who do not really know about those issues, and what are the kind of main opportunities that ahead of us? Thank you.
Okay. Okay. I'm going to be somewhat evasive in response to your very straightforward question, and just say this: that frankly, every academic institution, absolutely including HKU and absolutely including HKU Business School, needs to understand that ESG is no longer a sort of a niche subject, or sustainability, or however you want to describe and define it. These are no longer niche subjects. That these are sort of topics that pervade whatever the major, whatever the minors. Matters of sustainability pervade all of the above, and we really need to figure out how to hardwire all of this into our, not just the academic system, but of course the business system, financial system, et cetera, because what we're trying to do is sort of shift from the sort of the old way to something very, very new, which is very transformative, and it's hard, okay? And so we need to do what we can through our educational establishments to not just shift mindsets, but we're just creating an entirely new dynamic.
Thank you.
Yeah, so very quickly, I think just to build on what Ben said, on a more general skills basis, it's really the whole systems thinking process that they need to understand, because it's so interconnected and there are so many different pieces. So I think that is something that I think is quite crucial in the whole ESG world, and actually across the other sectors as well. If you look at that, something that's more sector specific, then I would say some of the emerging space that we're looking at is transition finance, for example, that is still evolving, and we are still trying to make sense of it, and we just don't see a lot of talent out there who actually knows this space as well. I think those would be the two that I'll mention. Yeah.
Thank you.
Yeah, I've been reflecting on what I heard from Professor Stiglitz this morning about, cooperation needed to drive climate action and, sort of broadening that to talk about ESG as well. I think it would be great if we could inject more ESG content into the finance programs, the business management programs, because I think Hong Kong, in terms of grooming ESG talent, has put much of an emphasis on ESG disclosure and more recently sustainable financing, like how to structure deals, but we need doers. We need doers who know how to do climate modeling in the context of financial management and marry the two. We need people in corporates to really, dream up strategies and put it into practice, and then circling back to disclosure so investors have something to analyze.
Okay, thank you. To wrap up, I want to conclude by advertising the schools, some initiatives. Starting from this year, we actually launched our first climate finance master program. Starting from next year, we will also have a ESG master program. And finally, the dean just assigned me a task yesterday, trying to find ways to make our school carbon neutral. And I don't really know how to implement that strategy. So for all the business leaders here today, if you have solutions, ideas, and about how to do that, feel free to reach out to us. And we are more than happy to explore those ideas in the coming years. And thank you again to all our panelists for today's participation. Okay.
A big thank you to all the speakers for the enriching discussion. We'll now have a short break for 15 minutes, and then we'll start the next session.